All right, beautiful people. Hello, hello. Tonight we are going to do a real estate Q&A. So I may be looking over here sometimes because I am also live on IG. So if you have any real estate questions that you want answered tonight, definitely go ahead and put them in the chat. I'm looking forward to it. I already have some questions from some of my clients had some of these questions, but also just questions that I've had asked of me over time. So I'm going to be going through it, very informal, just basic Q&A, real estate. You ask, I will answer. Okay. So regardless of what platform you are on, I'm able to see you. Hello, hello, hello. And chime in with your questions, chime in if you have anything to say. And we're going to go ahead and get started because, and if you're watching this as a replay, make sure you do hashtag replay. Tell me where you're from and let me know what your question is, because I look forward to answering those questions. Some people are looking to buy real estate investment deals. Some of you are looking to get into being a homeowner for the first time. So, this may be a series that's going to be more than just one night that we're doing this, because the most important thing is I'm doing these lives is that so that we can be able to answer those questions. Lauren, hello, beautiful. The theme tonight is just real estate Q&A. So I'm asking any real estate questions that anyone have. I do have some questions here, but always just chime in with whatever question that you have, and I'll be happy to answer it. All right, so let's get down to it. First question I have here is, are mortgage rates going to go down? I have this question before. Mortgage rates are going down. Here's the thing. Right now, the reason why mortgage rates usually go up or down is dependent on the market, right? The Fed sets the minimum. And so when the Fed sets the minimum, you got to understand this is macroeconomics here. Okay. Just think of it this way. Whenever you are in the economy and there's a demand, right? There's a high demand. And there's other things that do take into account when it comes with the interest rate. But high demand allows for us to kind of drive down that rate and sometimes drive it up. So the reason why rates really go down is because they want you to go and buy, right? So when rates go down, you want to go buy. The reason why rates increase is usually due to social economics, politics, which we ain't gonna get into, but also rates will go up because of inflation. But let me tell you something that I love about rates, they go down. And so now that we are in this cycle of where rates have basically plateaued where they are now, we have now put ourselves in position to be able to start seeing those rates start going down. So for instance, I locked the rate today for a client, and yesterday that rate cost me $1,000 more than it is today, right? So you got to understand that timing the market, you cannot time the market, but you want to be on your P's and Q's, especially if you want to purchase an investment property or your own house, because rates will go down. But if you are looking to buy now, I still say if you can be able to handle a 5 to 6% rate or have a down payment, go for it. Get that house. Don't go house poor, but get that house because you can always refinance in as little as 6 months and be able to get a lower rate when the rates are lower. Okay. All right. So somebody, and then that's the same question of why our interest rates are high. It's nothing we can do about that. You can always buy down your rate. Okay. But we talked about that last week. Instead of buying down your rate, buy down your principal so that you can save more on interest, pay your house off sooner, and be able to lower your payment. Okay. So that's a way that even though you might have a high interest rate, you can still be able to take advantage of that. All right. So how much house can I afford? My people over here on Instagram, if you got any questions, about anything about real estate, put it in the comment section. I would love to be able to answer your questions. I am looking over here because I am live also over here, but chime in. I'm here for you. Let's get going. All right, next question. How much house can I afford? Simple terms here. This is how I can say that you can afford your house. Okay. Take your income, your gross income, because that's what we actually go off of, right? Your gross, not your net. This is how you can trap yourself, because you can qualify off your gross. And let's say you bring it home $6,000, but your net is 6,000, your gross is 8,000. We actually qualify you off your gross income, which is that 8,000. So you got to be careful with that. I tell anybody, be careful on that trap, because you could be house poor thinking you can, just focus on the net. Okay. But how much house can I afford? So you take your income. This is basic math. Take your income, right? Have all of your debts listed, right? So list all of your debts. And then let's say you have a house that you're looking to get, include taxes and insurance in that, and you have a $2,500 payment. And then you got $2,500 of debt, right? So now you got $5,000 total. Well, your income compared to that debt, I say max, just to be on the safe side, 42%, right? So if $5,000 is your mortgage payment plus all of your debt, then we're going to divide that by 42%. So for that month, every month, your gross income needs to be about $12,000, right? And that's, like I said, if you got $2,500 in debt, that's a lot. That's a lot of debt. Okay. Usually, you may see, so like, for instance, let's say you have $1,000 in debt and your house is 2,500, right? So you just take 3,500 divided by 42%. That's $8,333. So let's say $8,350, right? That's off your gross, not your net. So if you make that a month, then okay, you're looking at $2,500 payment. So that's about a $300,000 house, right? 300,000 plus house. All right. So that's just rule of thumb. There are calculators out there that you can use. If you click my link, that's in the description. There's calculators on there as well for your help. All right. So we got a question here. Because the calculations thinks we have more money than we actually do when they qualifies. Yes, that's the thing, you guys. On our end, we're looking at the gross income, right? And I'm talking about W-2, W-2 like standard income, right? We're looking at the gross, because even if you got disability, we gross up the income, right? Because we're able to do that. I don't know why. Don't ask me why. I don't know. But that's just how they're calculating that, because at the end of the day, if you were really making that amount, they're adding back in Social Security, taxes, things like that. Okay. But they qualify you off of your gross versus your net. And I know it sounds crazy, but that's just how they do it back in. So if you ever wonder, hey, why am I qualifying for less because of this? It's because of your debt, most likely. Okay. So rule of thumb, 42%. There are programs, y'all. I'm telling y'all, there's programs out there that will go as high as 50% DTI. VA programs I've seen go as high as 60% debt to income ratio. But to me, my friend, please know that for me personally, I feel like that is you on the borderline of house poor. Okay. Because you are buying more house than you can afford. When I say house poor. Yes, Lauren, I appreciate that. But yes, they will qualify you off of something that you're not even getting yourself. So take heed on that. All right. Next question I have here. Keep the questions coming in. Lauren, I appreciate your interaction. So next question here. What does my credit score need to be in order to get a house? All right. This is how I'm going to keep it simple here, okay? I'm going to keep it simple. If you are in a government program like FHA, they some of their programs go as low as 500 credit score. The FHA, mainly you'll see like a 580 minimum. When it comes to conventional, 620. Jumbo usually wants you to be 640 or above, or some programs let you do 620. Investors, you're going to go about I say have at least a 650. But if you want some great rates as an investor, you want it close to 700 or past 700 credit score. All right. Next question I have: can you buy a house with bad credit? Yes and no. As I said before, there's programs that are available where you can, VA and FHA usually, where they go as low as a 500 credit score. Okay. That's all I can say about that. That's what I can, if you consider 500 credit score bad credit, then there you go. There's room out here for everybody. Okay. All right. Next one. Are mortgage rates negotiable? Yes and no. No, you can't say, well, I want this rate at this, and I don't want to pay this and I don't want to do. It isn't that type of negotiable, but it is in terms of asking, hey, I would like this particular rate, right? So it's up to the job of the loan officer to be able to give you the best, not only rate, but making sure that you're not being overly charged for that particular rate. And what I mean by that, like I said earlier, I was able to save a client $1,000 versus locking it yesterday versus locking it today. Saved them $1,000, right? So on our end as a loan officer, okay, I can't speak for any other loan officer, but for me, okay, for me, I look to make sure I'm getting you the best on the back end, right? To save you the most amount of money. Because at the end of the day, I want to keep more money in your pocket. Okay. So rates are negotiable in terms of when you choose a rate, depending on the lender, it can cost you different. It costs you a certain amount of money, different types. Okay. Different amounts. Excuse me. All right. Next question here. Next question I have here. Which home loan is the best? That will be more so for your preference, right? So if you're an investor, you can go commercial, or what I like to talk about is DSCR, because I'm a big advocate about being able to buy rental properties and having cash flow. Best programs, if you are low to moderate income, I would say FHA. If you're in a rural area, USDA. If you have a great credit score, conventional, right? If you have a large down payment and you have a great credit score, conventional. If you don't have a really good credit score, FHA. So that is really like, depending on your situation, is going to determine which home loan program is best for you. Okay. All right. If you lock a rate and they drop lower before you close, can you get the lower rate? So you can change. So, okay. Let me say this. As a consumer, you guys, you have the ability to walk away at any time. This is by law, because the mortgage industry is put in place to benefit you as a consumer, right? So we have to make sure we're following the laws. We are doing everything in your best interest. And if you decide that you want to go with a lower rate, you can be able to do that, right? But here's the thing. On the back end, let's say you have a 6% and you say, no, 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 no. You're about to close within a week. And you say, no, I decided I want a 5%. Well, let's say now you want a 5%. So we will have to what is called redisclose, which means we will have to basically all those documents that you signed initially, we will have to bring them back out to you and say, hey, this is the new rate that you've decided to get. And sometimes, as I said, that rate, that lower rate can cost you. It can be the same of what it costs for that higher rate. But yes, essentially, yeah, you can drop to a lower rate, but that could slow down your loan process. So I would highly recommend talk to your loan officer or me, okay, before that happens so you don't slow down the process, okay? Because I'm a big advocate. If you lock a loan, we are on a time clock. Because if that lock expires, that interest rate expires, right? Then that means if it expires and I have to extend it, that could cost you as a buyer. As I said, I don't want you to be in a position where you are paying more for that loan. So it's best to have that from the beginning. Okay, talk to me. Let's talk. That's why I always do strategy sessions before I even ask for application or before you even, before we even get that far, because I'd rather know your situation now and say, okay, let's see if this will work. If it don't, it don't. If it do, it do. Let's roll with it. But the numbers, at the end of the day, the numbers matter. And so if you want to be able to switch your loan up in the middle of the process, go right ahead. But just know it's going to slow down your process. All right, let's see. Are there any tax benefits for investors or even primary homeowners if they sell your property and it has equity and you then use it for the next property? And what happens if you spend it on other debts? That's a heavy question. All right, so let's start with the tax benefits for investors, okay? So, tax benefits for investors, not only can you have depreciation, right? You can use depreciation on all of on the purchase of the property, everything that's in the home itself. You also can the tax benefits of you being an investor is being an investor. Also, some of the tax, and I'm not a tax expert, okay, y'all. One of the Carl Dennis, I love when he talks about accelerated depreciation, where you can accelerate those depreciation to help you offset the cost of that investment. Then that's just some of the tax benefits. There's way more. Talk to a tax professional. For primary homeowners, I'm a primary homeowner. And one of the things that I'm able to do when it's time to file taxes is we're able to, the interest that we paid into our property, we're able to put that on our taxes as a deductible. Okay. So let's see. If they sell the home, if they sell your property and it has equity, can you use it for the next property? Yes. Okay. Yes, you can. You can even use the refinance. If you do a cash out, you can use that to also purchase your next property. If you sell the property, depending, okay, the capital gains, there is a capital gains tax if you lived in a home for a certain amount of time. Then you can be able to not be able to pay capital gains tax. So what I mean by capital gain tax is it allows for you to, let's say you sell your home, you get 100,000. Well, you got to pay capital gains on that home. But when it comes to a homeowner selling, right? When you sell that primary residence, then you're able to exclude, you may be able to exclude up to a certain amount that allows for you not to pay capital gains on that home. Now, I know if it's an investor, you can do what is called a 1031 exchange, and be able to just roll that capital gains tax into your next property, right? So you can do an exchange, and it's called a 1031 exchange. All right. All right. Let's see. Now, like I said, there's about 5 different questions in this one question, Lauren. So I appreciate it. So now she asking, and what happens if you spend it on other debts? So whether you refinance or whether you are selling it, that's pretty much your money. Okay. You can do what you want with it. As an investor, though, if you do a cash out, they expect you to take that money and put it into another property because it is business purposes. Okay. It's a business purpose. If you put it in your pocket, then it's going to count towards, you're going to be taxed on that. Okay. All right. So go and buy more investments, right? Pay off your debts. Be free. That's what I love about real estate, because you can use, I've seen individuals save so much money from doing a refinance of just paying off debt, right? Paying off debt, well, rolling over the debt into their home loan. Why? Because you're being taxed for a short amount, not a tax, excuse me. You're paying more interest in a short amount of time than if you were with it being in your home loan. And I already told you how to pay it off very quickly so that you're saving even more money in your interest, and you don't have to wait 30 years before your house is paid off. All right, let's see. If you have any questions here, IG, we're doing real estate Q&A tonight. We've answered probably a good 6, 7 questions. So if you have any questions, chime in. Would love to be able to answer them. All right, we got another question that came through. Can you take out a second mortgage only on the equity? So when it comes to a second mortgage, it's not necessarily called a second mortgage, but it's called a home equity loan. Not a line of credit, but a loan. And essentially that is a second mortgage or a second lien on your property. All right. And it does, your house do have to have equity in it. Okay. That's the kicker here. You have to have equity in your home to be able to borrow that money from. And you can't do 100%. I'm sorry, you guys. If you are not VA, you will not be able to tap into 100% of your equity if you refinance. Okay, that's only for VA usually. All right. Thank you for those questions. So I do have a list of some more questions here. Let's see. What is the best property to start off with in real estate? Mobile home, houses, or multifamily? All right, so the best property is your preference. There are loans that there are financial institutions, right, that will let you do mobile homes, houses, condos, multifamily units. So it's really up to your preference and if you can afford it. All right. Now, excuse me. Personally, for me and my husband, I'm gonna tell y'all a little backstory here. When we first started our real estate journey, we could not even afford a foreclosed mobile home. That's how jacked up our credit was. We wasn't ready, right? We didn't know what we was really walking into. But as we learned more about the real estate process and what it took to actually qualify, and so when the banker told us, hey, this is what you need to do this, and then come back to me, within a year and a half, we was able to buy our first property for triple the amount of what that foreclosed manufactured home was. So here's the thing, have your ducks in a row before you start looking, because when you start looking, you want to be able to be prepared and be able to jump on that house that you love or that will make you money. Okay. All right. Who buys houses for cash? Anybody, right? So when you buy houses for cash, usually cash deals are really good for investors, right? There's this show on HGTV. If y'all watch it, is with David with all the tattoos. These are people that hit the lottery, and they're basically taking the money that they made from the lottery and they're buying their houses pretty much outright. When it comes to cash deals, the best thing I can say when it comes to offering a cash deal is go in, and I'm not going to say lowball, okay, but you want to be able to walk away with some good amount of equity in that home, especially if you're coming with cash. Why? Because you're coming with cash. You're not worried about is your loan going to get qualified? The only thing you need is cash and a real estate attorney and or a title company. Okay. And you good. You got your house, right? And that's something that you can use as collateral to be able to get more properties or to be able to get financing, things like that. Okay. So who will buy cash? Usually investors buy cash. The only really time I've seen someone buy their home cash is because they came into a lump sum and they want to buy the home cash. Usually, as I said, those are usually the people that buy homes cash. All right. How do you get a home loan? You fill out the application. That is it. Fill out the application. And then on the application, when you talk to your loan officer or me, okay, call me, they will be able to tell you what's needed in order to qualify for that home. All right. Awesome. Awesome. All right. Let's see. We got a couple more questions here for the real estate Q&A tonight. These are buying homes without. All right. So we have about 1, 2, 3, 4 more questions. If anybody got any questions, even after we're no longer live, definitely send them so I can be able to answer them. I will be able to send it via message and or be able to create a video so that you can be able to get your question answered. All right, so now we have the question, buy a home. How can you buy a home without a mortgage? The way that you do that is by cash, okay? So cash is used if you do not want to have a mortgage. A mortgage is just so that you can be able to leverage, right, the cash that you have in order to purchase that property. I personally, this is my preference, I would rather pay 3.5% or 5% versus 100% on a home that I can be able to leverage, because I can take 100,000 and buy 10 properties where I'm paying 10,000. I know that is very basic math, but I'd rather be able to buy multiple properties with 100,000 versus paying for a home outright with that 100,000. Okay, but you can buy a home without a mortgage, and the way you do that is with cash. All right, next question. How can I buy a home without a credit score? This right here, my friend, when I tell you that a lot of people do not know this, but you can buy a home without a credit score. All right, sorry, I got paused here. Okay, we're back. I got a call. So the way that you buy a home with a credit score is called a non-traditional credit. And what we do is, instead of using credit scores, we go off of other debts that you have paid on time. And so it's a little more, private eye type of thing. We got to make sure that you can make the payments back. But usually if you have rent that you've been paying for years, you can use that. We can use utility bills. There's a group of things that we use in order to determine if you are qualified in terms of credit score if you do not have a credit score. All right. let's see here. How do I buy a home without 20% down? Okay. You do not, even with investment properties, you're not required. I'm gonna say that, okay? You're not required to put 20% down. And I know, and that's a myth around that, because a lot of individuals feel like they have to put 20% down so that they can not have to pay for, my light must have got hot. Yeah. So they don't have to pay for mortgage insurance, right? So they're like, man, I don't want to, especially if you get a conventional loan, they're like, hey, I don't want to pay mortgage insurance. I'm going to put 20% down. Go right ahead if you don't want to pay mortgage insurance. Okay. Nothing wrong with that. But you're not required to put 20% down on your payment. With FHA, 3.5. With conventional, they have some programs. We have Home Possible, Home Ready, that came from Fannie Mae, where they require 3% down. There's programs out there, even for investors, where you can put as little as 15% down. And what I love about one of our lenders that we partner with, they actually you can seller finance the 15%. Right? So if you seller financing the 15%, this is for investors, okay? Listen to me. Seller finance the 15% with them, right? And on top of that, that's 15%, right? That's the 15%. And then the 85% is now the mortgage. And now you're renting out that property with, you basically use none of your money, right? Except for just the closing costs, but you're winning, right? So now you're able to leverage your money more, which is why I say I would never pay full cash on a property if I'm living in that property. If I am doing a deal, right? You can be able to have investors that's willing to put the cash in, so you don't have to have a mortgage or put 20% down, but you can have an investor be able to put the cash up for that property, right? And you're coming out the property with little to nothing at all. And you can leverage it with an exit strategy of where you're refinancing or selling that property after it's fixed up and or rented out. And now you can cash out on that property, pay your investor, and be able to move on to the next property. Okay. So you don't have to put 20% down. Be creative and you utilize your money where it's going to be most for you. Okay. 20% down don't always make sense. All right. Lauren said, what is mortgage insurance? So mortgage insurance is basically insuring the mortgagee or secondary markets. Okay. Let me explain what that is. When you close a loan, sometimes lenders will sell your loan to the secondary market. That's Fannie and Freddie, right? Y'all heard of Fannie and Freddie. They'll sell off the loan, right? A bulk of loans, they'll sell it off. So that's kind of how in 2008, you know, when who was it? Goldman Sachs? No, not Goldman Sachs. Oh my God, I'm drawing a blank right now. Y'all help me out. The company, when all those houses went in on foreclosure, and they bought them all up at one time, right? A private equity firm. I can't remember their name right now. I'm sorry. They bought them all up. That's usually how the mortgage industry works on the back end. You don't know it, but they sell it off. No, it wasn't Madoff. It wasn't Madoff. It was, I can't think of it. It was too, I can't remember it, but if I remember, I'll put it in the chat so you guys will know. And if you know, chime in. It wasn't Madoff. It was, I want to say the brothers. I can't remember right now. Okay, anyways, but they sell your loan off, right? So that they can recoup that money back. So mortgage insurance is saying, hey, this potential buyer could be a potential risk, right? This is for residential, not commercial. This particular buyer could be we want to make sure we get our money back. So we're going to put insurance on this property and they're going to pay this every year, right? So with conventional, you paying insurance, right? You paying insurance. If you have 80% LTV or higher, you're paying insurance. But as soon as it goes lower than 80%, you're able to get it removed off your loan to value. FHA, you have to pay mortgage insurance for 11 years, regardless, right? Regardless, you got to pay mortgage insurance. And that's just how they do it, right? This is ensuring that you're going to keep that loan. That's essentially what it is, okay? All right. So if y'all have any questions, chime them in. I have my last question here for tonight. Okay. I do have more questions like I said, I have plenty of questions from my clients, but also just what's always been asked to me. So chime in. If you're watching this as a replay, put your questions down below so I can be able to answer them. All right. So the question here is, can I buy a home without a bank? Yes. I do not work for a bank. Okay. We do have lenders that are banks, but we also have financial institutions. We also have hard money lenders. We have a different mix of different individual companies that we work with. So you don't always have to go to the bank. I'm not talking junk about the bank, but I'm gonna just say what I've seen a difference is some banks will be a little bit more lenient because you have, a checking there, things like that. Some banks is not trying to give you the money. Okay. Some banks are like, no, you don't, their guidelines, and guidelines is basically what they can and cannot do, are tight, right? Are tight, which is why I advocate for reaching out to me or a home mortgage brokerage or a mortgage brokerage, because they will have multiple relationships with different financial institutions to offer you the best rate, the best, making sure, you're saving in the end. Not saying banks can't help you save. There are banks out there who do the same thing that any other financial institution does. But you do not have to go to a bank in order to buy a home. You can just come to me. I got you. Nah, but in all seriousness, all right, let's see. I'm going to give y'all one more question. And then we'll come back next week with even more questions that that have been submitted to me. All right, let's see here. Oh, this is a good one. Okay, this is a home buyer. Okay, can I buy a home without an inspection? I'm saying this to all of my investors, and I'm saying it to all of my home buyers. No, please do not buy a home without an inspection. Now, the only time I would say take caution, take heed on that is if you're an investment property and you kind of know what's going on and you're doing a cash deal. You might be buying it as is. You might do an inspection just to see what needs to be done, or what comes up on a report, just for that instance. But I always highly suggest you do at least these two things: get an inspection, okay, and do a title search, because there can be liens on a property that a contractor done put on there, the state done put on there, somebody done slapped on a property. So those are the main two things you want to definitely make sure you're getting your home inspected, especially if you're buying it for your residence. Get the home inspected so that you can make sure that you're in position to buy a house that is worth buying. Because the last thing you want to do is get a house and then you find out Lehman Brothers, that is it. There you go. They might have found, and that's the thing. They're part of the they're part of that secondary market that buys up these houses. There's private equity firms, hedge funds, private investors. There's people that are behind the scenes that you will never know about right? There's banks. There's Fannie and Freddie is only the people that you know because they talk about it all the time. But yes, Lehman Brothers. And here's the thing about that. I don't know if y'all caught this. The government bailed them out, right? They filed a bankruptcy, but they got bailed out, and then they bought up the houses for pennies on the dollar when it happened. So just think about it. If you're an investor and you want to get in and you want to be able to, flip a portfolio, you can buy a portfolio of homes and be able to profit off of that, right? Because you're an investor. If you ever read Cash Flow, Rich Dad, Poor Dad, very simple. He says this: you're an employer, right? You're either an employer, self-employed, which means you own your job, right? You own your job. You work a job, own a job, right? But on the other side of the spectrum, on the other side of the fence, you have business owner, which business owners build systems, right? Business owners build systems, and you have investors. The main one you want to be in is the investors. Why? Because investors is going to allow for you, being an investor is going to allow for you to make way more money. Why? Because now you are leveraging your money, and this is where compound interest come in. This is where your money is making money for you. It's as an investor. So if you are investing, then your money should be compounding over time. If you are an employee, right, you're paying for your time. And Myron Golden said this, and I want to share this with you because I'm like, you know what? I'm going to stop saying this for now on. We all say time is money, but time is more valuable than money. And I love how he referenced it in this way. He said, he referenced it two ways, right? So if you were on your deathbed and you knew it cost $1 million to cure you, and you had $1 million, would you pay that $1 million? Yes, because your life is more important. If someone said, I'll give you $1 million if you kill yourself, and you're going to be like, no, I love my life. I want to live. Don't do that. I don't condone that. Don't do that, y'all. But what I'm saying is that time is more valuable than money. Being an investor allows for you to get your time back and leverage your money. Being a business owner that has systems in place is going to allow for you to get your time back and to make money. But if you are self-employed, you are using the most valuable thing that you have, which is time, because you're not being able to leverage yourself in a way. That's why if you want to really be able to be free out of the rat race and be free from being the one that is owning the job, right? Then systems is going to allow for you to do that. Leverage is going to be allow you to be able to do that. And so you want to be able to do that early on and learn how to do that early on so that you can benefit later on. Okay? All right, so I'm going to leave it on that note. I love talking about that. Maybe we might talk about that next time, right? Talking about how you can really make some money in terms of building a business versus owning the business, right? Because sometimes you want to take off, sometimes you don't. And I get it, okay? I get it. Being self-employed, I get it, right? So I'm an investor in terms of real estate. I love it. I don't have to do anything, right? I did it one time and the income comes in. Love it, right? When it comes to business, yes, I'm the one that mainly does the mortgages, but I train, right? I train because I don't want to always do it. I like talking strategies. I like coming on talking to you guys. This is something that I love. So this is something I choose to do, okay? But I can still take a break. if I can't go live, I can record and be able to have it, go live for me. So I can be able to leverage, because time is more valuable, especially being a mother. For me, time is the most valuable thing, because one thing I'm not going to do is miss my children because I want to go make a few bucks, right? But I know what I can be able to do with my children and leverage that in order for it to grow, so that I'm not shortchanging myself when it comes to growing as a business owner, but I'm also not shortchanging my family. So you got to find out what works for you. What's your medium? Didn't mean to go into that spill, but when we start talking about money and stuff like that, I kind of, y'all know me. I love talking about money and business. Why? Because it is not evil. It is a resource and a tool that allows for you to enjoy life the way that you want to and desire. All right, beautiful bosses. Until next week, we're going to have another real estate live Q&A next week. So join me 8 p.m. Eastern time. And I look forward to seeing you then. But until then, make sure you slay every day with style. All right, beautiful bosses. See you.